All right, so I welcome you all once again to today's class. This is Targets from Target Professional Consults. Today we are going to diagnose extensively on two very important standards. We are going to begin with IAS 10, Event After Reporting Period, and its applicability. So that is the first section. And then we'll continue from that. Yeah, so this team targets, all our central team are in position. And we also thank you for joining us. Please and please again, if I've not gone through the earlier videos, do so. Yes, because half knowledge or half information is suicidal. Yes. So you have to get a complete information. All right, so let's start. As usual, the chairman for today's program is still the usual targets with all co-pilots and captains. We can now start the game. Event after reporting date, IAS 10. Accounting standard number 10. Event after reporting date. This standard, you need it both level 2 and level 3. So please take notes. Many professional students think IAS 10 is a basic standard. Trust me, it's one of the important and fundamental standards that we have to take notice of. Either reporting date or period. So we can normally use the period. Over here, this standard was issued in May 1999. That was the first time this standard came. So as at 1999, they have issued IAS 10. What the wow. Now, the objective of this standard is to prescribe the accounting treatment of events that takes place after the preparation of the financial statement. So you can simplify it and say to prescribe the entity when they should adjust, or to prescribe what to do after the preparation of the financial statement before its publication. Good. So take notice of that. The objective of these standards is to prescribe the treatment of events that takes place where after the reporting period. Before I start this, I normally simplify this with ordinary target normal line. Let me do the normal line for you. And I want everyone to follow fully. Let's just assume that our financial year starts from January. So January, our year has already started. Where exactly do you think would this year end? Exactly 12 months' time, the year will end successfully. So somewhere December, year will end. Likewise, if we start, let's say March, if we start at March, may end in April. April. If we start in somewhere September, may end in October, in that order. So this is a starting date, starting date. Then we have what we call the reporting date. Reporting date. Take notice, that's all. So get these scenarios clear for us. If you understand these ones very well, please and please again, you will get it clear. I don't need to even continue. As soon as I'm done with this, I can even say that bye-bye. And you should be fine. See that? All right. Now, let's go. These are reporting dates. Please, where exactly would they prepare the financial statement? They have to prepare the last day of the year. The financial must be ready. So if it is December, it must be 31st day of December. Your financials have to be what? Ready. So 31st day of December, your financials have to be what? Ready. And then that is all. So take notice of that. 31st day of December, your financials have to be ready. Then when it's ready, when are you going to publish it? Accountant, you must know when financial statement must be published. It must be published latest by 31st March. By March, your financial, 3 months after the year end. Although some entity go beyond that, even extend it to 4 months. No problem with that. So let's say this is the another day. So let's say by March, ending of March, by March ending, we have to publish. The CEO together with the finance director have to sign the account so that we can publish this. So this is the publishing. So this is the date the financial statement being prepared. So third examiner preparation. This is the preparation, and this is the publish or issued or publish. Now the question is, what will happen between these periods? So this period, what do you think? What was the central focus between the reporting date and publishing date? So what will happen here? So any event that will take place right after they prepare the financials, but before they publish the financial, is known as event after reporting period. That's it. So event which normally takes place right after the preparation of the financials, immediately before it being published, those transactions are what we are going to study now. We are going to learn the application of those transactions. Sometimes some of the accountants will ask, target. Our year has ended, but we have not issued out the financial statement. But a lot of transactions are popping up. From January to March, transaction will pop up, promise. How do we treat it? Then I will just whisper to the accountant's mind. Apply IAS 10. Then I go. I don't say anything again. So in that case, what is the requirement? So take note of that. So I'm done. Obviously, what kept long will be the auditing. is the auditing. That normally keeps the financial statement waiting. So until auditors confirm that the account is clear or not, we can't publish it. So it's the audit period, audit season, January up to March. Then by March ending, they publish it out. So that is what we have to study over here. Now, events after reporting period are favorable and unfavorable events that occur between the end of the reporting period or date and the date when the financial statements are authorized for issue. What a wow. Take notice of this. So now let's go and define event after reporting period. So from the above discussion, we can now suggest that events after reporting period, please, from henceforth, I will call it EARP. In exams, don't do this in exams. You are begging. Shortcut, it's not allowed in exams, please. So tell the examiner that events after reporting period are events. They are what? Events or they are transactions. You see? Tell the examiner, comma, favorable or unfavorable. Favorable or unfavorable. I remember when COVID started. COVID started somewhere effectively middle of January 2020. So meanwhile, at that time, 2019 financial statement has been prepared. So COVID is a typical event afterwards, reporting period as at 2020. Good. Just a second. All right, so let's continue the game. So like I was defining it, event after reporting period. So say events are events or transactions. You see? Transactions. Favorable. So it can be favorable or unfavorable. That is where the COVID-19 example came in. Unfavorable. That's okay. So that's okay between. So mention those two dates. You know it already. Between the end of the reporting period. Between the end of the reporting period and where again? And the dates when the financial statements and the dates when the financial statement, please. when the financial statements are authorized for issue, or they are issued or authorized for issue. That's all. So I'm done with the definition for events after reporting period. That's all. So get the definition clear. If an entity prepares its financial statements after the year end, and if not published these financial statements, so even if it takes 500 years for the entity to publish financial statements, so long as they have not published it. So look at the two conditions. So number one, they must have prepared a financial statement. That's the first condition. Number two, they have not published it. They are yet to publish it before they publish it. So the normal publishing time should be 3 months. But one or the other, some entity can delay. They will have problems. The auditor will have problems with management, and it will expand the auditing period. So by the time you realize, it will be somewhere June, somewhere July. It still does not matter. So long as you have not published a financial statement, practically, IAS 10 holds. IAS 10 does not hold as soon as your financial statement is being published. When your financial statement is in the public domain, IAS 10 ends there. What a wow. So take notice that IAS 10 does not go beyond the time when a financial statement is in public domain. So if I should draw again, January, December, March issue, prepared. Now, IAS 10 does not cover here, no. So let's go. Types of event. There are two types of events. Types of event. There are two types. One, we have the adjusting event. And two, we have non-adjusting. Right after this, we are done. Then I'll go to the IAS 12, income tax. What a wow. You must know these two. This is the one that you have to get it. Non-adjusting event. Here, there are 5 examples you must know. The standard provides up to 12 examples. So I'll take my time to elaborate on all these examples, and then you are free to go. All right, so that is it. So let's take them one after the other. Adjusting events. There are 5 examples. See, the standard has made it clear. 5 examples. So you must know these 5 examples. And 12 examples in the non-adjusting events. Let's start from adjusting event. In all, you must know the accounting treatment. Adjusting events. Now, when you say adjusting events, we are talking about events after the reporting period that provide evidence of conditions or evidence of existence at the end of the reporting period. That's all. So there are events after reporting period that provide evidence of its existence before the year end. Take it cool. Adjusting events are events after the reporting period that provide evidence of their existence before the year end. So it's like dicey. The event will occur naturally after the reporting period. But as soon as that event takes place, there will be evidence that this event had already existed even before the year end. Yes. So that is what we are talking about. If you understand it that way for me, you are free to go. That is it. Have you saved me? All right, so basically that is it. So we are going to take our time to understand it, especially the final level students. Maybe the examiner might not directly ask you a specific question on the event after reporting period, but in your explanation, you have to tell the examiner that this suggests an event after reporting period, especially in an advanced audit and assurance paper. You must know this for us. It's a very topical issue. Now let's go. So tell the examiner these are events that provides evidence of their existence before the year end. So let's go back to the diagram. So that transaction will probably take place here, but it provides evidence that it exists before December ends. So that is where we are coming from. That is the issue. So let's take notice of that. And we are free to go. Now we are done with the explanation. What is the accounting treatment? The accounting treatment, we can call it recognition and measurement. Recognition and measurement. It is the same as accounting treatment of event after reporting period. Now, before I go to this, let me provide more. The transaction will take place right after the year end, but everything suggests that this transaction exists. Again. All right, so when we talk about event after reporting period, the adjusting events, those events will probably occur after the year end, but it provides indication or conditions of their existence prior to the year end. So that is how it is. So it's like before the year end, that transaction exists, but it has not materialized. So right after the year end, you can see the transaction fully. So the question is, where are you going to record it? So now let's go straight to the accounting treatment. It's the same as recognition and measurement of event after the reporting period. You see, when I go too technical, like I come too simplified. How do you treat adjusting events? Then we now say that recognition and measurement of event after the reporting period. So those events, how did you treat them? First, the answer is just one line. You adjust the financial statement to reflect the impact of the transactions. What do? You adjust the financial statement I will very clear. You adjust the financial statement to reflect the impact of. So the entity shall adjust the financial statement to reflect the impact of the event. So tell the examiner that the entity shall do what? Adjust. The name is adjust. If you can see the word adjust in your write-up, that's all. So adjust the financial statement to reflect the impact of the event. Which event? The adjusting event. So now I'm done. Don't forget, IAS 10 provide 5 specific examples. So I'm going to take my time to walk you through these examples that if you see them anywhere, you must adjust the financial statement. So let me give you a practical example. Practical example. In 2000 and before the COVID came, yes, 2019 financial statement. One of the banks in the country, I think Access Bank, prepare 8 financial statements and then publish it. No, the financial statement have not been published as of that time. So the Bank of Ghana passed a regulation that they're supposed to make certain provisions. Out of that regulation, they're supposed to make provision on the loans they've given out up to certain amounts. So at that time, they've already prepared the financials, but the loans are sitting in the balance sheet in the books of the bank. So at the end of the day, provision has to be made. Even though this transaction came, the news came after they have prepared a financial statement, but yet to be published. So they have to now bring this prepared financial statement and adjust. So when you say you are going to adjust the financial statement, if the item is an asset, you add to asset. If the item is a liability, add to liability. So you have to now effect the debit and credit of that transaction with your financial statement. That is all about the adjusting event. We are done. So now let's go straight to the examples. The 5 examples. Don't forget, I'll give you 5 examples clearly stated in IAS 10 with their detailed or simplified explanation. So examples of event reporting period, that is adjusting event. So know these examples for me. Now, the first example is that settlement of court case. Yes. Settlement of court case that the entity had at the end of the reporting period. So all these transactions. So number 1 is settlement of what? Court case after the reporting period. Take note. So after the year end, you go and pay to the law court $45,000 as a result of what? Pending case. So before the year end, the case was still available. So take note. Before the year end, there was a pending case, but the judge have not pronounced any payment, any settlement. But right after the year end, the judge said that even though he has not finished the verdict, we should come and pay 40,000, or he has finished his verdict, and the truth of the matter is that we found guilty, so we have to compensate the other party by paying $500,000, and we have to pay $100,000 to the court and all the damages and the rest. It's a typical example of what? Adjusting event, because there's an evidence before the year end, the court case was still there, just that you have no knowledge about how much the judge will pronounce as your final payment. So that is why we don't have evidence. That's why we don't make any provision. That is why we do not record it in our books. But right after the year end, the judge said that I'm done with my decision. And then they phrase what? Is it a bell, right? They phrase it, boom, that we are done. And then we move on with the game. Now let's go to the show. Example number 2. Please take the conditions well. The case must be there. If you start a fresh case, let me, where's the case? If you start a fresh case somewhere here, the case started here, and they ask you to pay here before the year end, it does not qualify. The case must have been in progress before the year end. So the case, as at this time, the case is still there. It's not when after the year end the case starts. Please take notice of that. Don't let any examiner confuse you. Tell them that target is around, and you've been to the executive master class. The case must have been there before the year end. That shows that there's evidence, that evidence section. Example number 2. In fact, example number 2, impairment of assets after the year end. What a good news. Impairment of assets after the year end. That is it. There are 2 types here. Here, let me break it down, because most of the examples you normally write are coming from here. You see, if we have an asset on our balance sheet among the items, and right after the year end, we have received an information, and the information is a bad news, telling us that our asset that we have recorded in our balance sheet may have been impaired, or it has been impaired. Then it tells us that even before the year end, that impairment exists, just that we have no idea. Now it has come clear. So we must adjust the financial statement. This is very dicey. Let me go over. After the year end, if there's evidence that suggests that our assets that we have in our balance sheet has been impaired. Typical example, bankruptcy of a customer. Bankruptcy of a customer. Yes. So a typical example is what? Bankruptcy of a customer. Bankruptcy of a customer, aka bad debt after year end. So that is why anytime they pass a bad debt in a footnote, we adjust the financial statement. So tell the examiner bad debt after the year end is a typical example. So some of your customers, maybe they wait right after the year end, and then they will decide to do what? They will decide to die. Some of the customers, they wait when they append the financial statement, they will not die. They will be very strong. Right after the financial statement have been prepared, then they decided to what? Gone too soon. What a shock. And then they go, leave you peacefully. Meanwhile, you have not insured their debt. So they are owing you. In that case, that debt must be what? Impaired. It means that the financial statement must be adjusted before we publish it. So take note of that. Another typical example has to do with inventory. Sale of inventory after the reporting period below their net realizable value. All these are examinable examples that you have to take notice of. So sale of inventories, all of them after the reporting period, but below their what? NRV, net realizable value. So these are the two examples I can give. Please look at this example carefully. Any examiner setting ICA, ACCA, similar question, we only have to visit the standard, pick any of the examples that students are not familiar with, put them in a practical context, prepare it and bring it to students for them to answer. That is all. Okay. Now let's go to the number 3. Once target is in, no way. Please. Step-by-step approach. Now, determination after the reporting period, asset purchase. The third one, let me explain it to you like this. Imagine at the time that after you prepare your financials, and you open one of your drawer or cabinet, you find out a receipt, a source document of certain things you have acquired. So it tells us clearly that at the time that you are preparing a financial statement, because those receipts were not available, you did not include them in the financials. So all what I'm trying to say is that sometimes at the time that at the year end, there'll be a lot of pressure on you. So you may end up forgetting about some of the things intentionally or unintentionally. So after the year end, when you take your time going through, when the pressure has been resolved, because sometimes they need the financials to determine the annual bonus. They need it to determine the dividend, the final dividend payments. So if an accountant, the year end is due and your financials are not ready, pressure. So sometimes you may end up skipping some of the transaction because the source document, the receipt of it was not available at that time. Or it's even missing. And because there's pressure on you, you will forget about it. But right after the year end, you got information. You were searching through the files and you got to know that certain receipts have not been captured in an account. This one there, nobody should even tell you that. Nobody should even come and tell you that, go and add it. Run and go and add it to it. Run and go and add it to it because they were part of the year's account. Just that at the time you're preparing, we're not there. That's why I did not add it to it. So that's what we are going to see. So let's find a very nice sentence for it. See the way I've explained it to you. You can write it in your own sentence, please. We don't have one way. So determination after the reporting period. So determination after the reporting period. the receipt of goods purchased. It's not only purchased or sold. So I'm done with example 3. Don't forget, IAS 10 provide 5 solid examples of events at the reporting date. You understanding these 5, you are done. No question again. She come and then hand you. If you sleep walk, there's no doubt that, oh, I've not completed all the examples. So no. Please. If you sleep walk, if you walk with happiness. If you join us for us to finish all these 45 standards by in 10, we do the first 10, second 10, the next 10. And we are doing only the examinable standard first before we come to the practice standards. And then we move on with the game. You got to know all this. Now let's go to the next one, number 4. Example number 4. Example number 4. Example 4 basically talks about discovery of fraud or errors. Discovery. Good. I just remembered that we did IAS 8. The last meeting, there's a connection here. So discovery of fraud or errors. That's all. So you see, these are not prior period errors. Take notice. These are current year errors. So imagine we prepare the financials January to December, around somewhere 15th of February, when the auditors were auditing the financials, they saw a material error, material misstatement. So the auditors came and told us that, oh, Mr. Accountant, I think there's a material misstatement that we have discovered. Please, can you correct that? This is not prior period. This is a current error. If it would be a prior period error, IAS 8 will deal with that. So take notice, IAS 8 covers errors coming from the previous year. Then IAS 10 will now deal with errors that occur in the current year. So know it, any mistake that occurs in the past should be corrected using IAS 8. Any mistake that occurs in the current year must be corrected using what? IAS 10. That is all. We are done. What about future error? It will take care of itself. We don't know there. There's no evidence. Now let me go to the last example, and I'm done for adjusting events. Don't forget the 5 examples. The standard make it clear. Number 5, profit sharing. Profit sharing. Profit sharing. Or bonus payment. Or bonus payment. Bonus payment. There's a caveat here. If the entity had a present legal or constructive obligation, there's a caveat here. If and only if conditional statement, if the entity has a present legal or constructive Constructive obligation. Obligation. Good. Let me explain because I have an idea. Yes. Now, when you say profit sharing or bonus, every company, sometimes if their workers achieve the budget, they give them something, some chop anytime. So either by contract, that's a legal aspect, by contract, or by workers union, by the Labor Act, it can force an employer to pay a certain amount to an employee, or constructively your past behavior, anytime the entity achieve its budget or its target or its goal or its objective, there's certain amount they pay to the employees. And this year, the employees have hit the target. They have hit what? The target. Before the year end, they've hit the target. And they paid the bonus to them after the reporting period. Please, this is a typical adjusting event. And you are aware of this. Because they use the year-end results to determine whether bonus should be paid or profit must be shared. Sometimes it is legal, it's by contract. Some banks in Ghana or some banks operating on this earth, their MD or their CEO has a percentage of the entity's profits. So stated in the contract letter or employment letter that anytime you help our bank, our institution to make profit, come and take 1% of it. So this year, if they have made a profit, so I have to just cross my leg like this and wait for the check to drop. So the entity will always pay it after the year end. They will never pay it within the year because the year must end and they must prepare the profit first before profit or loss statement first before we can determine whether we have to pay this money. This is by legal. Then constructive, if they have become part and part of you, it has become a past behavior, a constant behavior. So it has become a norm. That is it. So I'm done with the 5 examples. Any of these is an adjusting event. And let's go to non-adjusting event to end the game. Over there, so I'll give you 12 solid examples of non-adjusting events, and you must take notice of all the 12. Let's go. Non-adjusting event. Please, I will not define the definition the same as adjusting event. Just come and put the event that provide, that do not. So just come and put do not here. So they don't provide any evidence. So do not. So say do not. There are events that do not. Place this one in that definition, you get a definition for non-adjusting event. So let's define it. The event that do not provide evidence of its existence before the year end. And then that is it. So take notice of the definition. They do not provide evidence of their existence before the year end. So they only provide evidence of their existence after the year end. After the year end. After the year end. Good. So, for example, the event will take place somewhere here, but it provides evidence that exists from here. That's all. We are done. What is the accounting treatment? And here I want everybody to understand this treatment very well. Please and please again. How do you treat non-adjusting event, the accounting treatment is very important. And I want everybody to get it clear for us. Please try as much as possible to get it clear about the treatment. Of it. Now, let me pick. Okay, so when I'm done, I have some nice example for you, and we move on. I have nice examples. Now let's go with the accounting treatment for the non-adjusting events. We can still call it what? Recognition and measurement. And there's some interesting news here. So take notice of that. What's the interesting story here? Now, if a non-adjusting event, or if non-adjusting events are material, look at the condition here. So don't just tell us that we must do this, we must do that. There's a condition, and I am always careful about condition. Please take notice about that. Don't go and change the narrative and make it factual. We'll mark you down. If you make it a factual statement, this is a conditional statement. If the non-adjusting events are material, then the entity must disclose. The entity must disclose. That's all. So you must disclose. You don't account for it. Please do nothing. Non-adjusting event, do what? Do nothing. So that means don't adjust your prepared financial statement. No. So that is it. So don't adjust your prepared financials. You disclose two things. And that is what I want everybody must take notice of. The nature of the event. IAS 10 stated clearly that you must disclose the nature of the event. The nature of the event. So you tell us, describe the nature of the event and the financial impact or the financial effect. Estimate its financial effect, that's all. Estimate its financial effect. So we are done. So that is all for the accounting treatment for non-adjusting events. Disclose the material ones. What are you disclosing? Tell us the nature, tell us or estimate the financial effects, and then we move on with the game. And that is all. Now let's go straight to the game. Now let me give you the examples. Then I am done. What are the examples of non-adjusting events? Here I'm going to discuss about 12 examples. Number 1 and 2 is very shocking news. So let's go slowly. Number 1 and 2 is very shocking news. Number 1, dividend paid after the reporting or dividend declared after the reporting period. Dividend declared. Look at the word. Dividend declared or proposed. Dividend declared or proposed. Dividend declared or proposed after the year end. All this after the year end. Why are we saying local? Some of the examiners, they will try and confuse us that our year end December, somewhere 20th of February, the board of directors met at the company's first AGM and declared a dividend of, let's say, 20,000, a dividend of $20,000 was declared. Let's say this is 2019, was declared, and this is for 2019 year. So the just ended year's dividend will be declared after the year end. Please don't say that. Once they've said that this dividend is for 2019, so I am going to place it in 2019. Take notice. And here I'm going to explain to you why IAS 10 stated that. So if you wait for the year to end and you declare that year's dividend the following year, please don't come and bring it back and record it in the ended year. So typical example, we are in 2023. Let's say 2022 year dividend was declared somewhere 15th of January, 2023. So why do you declare 2022 dividend in 2023? Dividend, if you declare it after the year end, it must be for that year, not the ended year. Why? Now, please take the reasons careful. Now, dividend is a matter of policy. It is not obligatory. The shareholders have a right to receive dividend. It is not obligatory on the entity. There's no company that is obliged by any law to pay dividend. So that failure to pay dividend, they have to come and then fine you, pay penalties, or lock your company. But payment of dividend is the matter of policy. And policy is the hands of the directors. So if the director feel like they have to pay dividend, they will pay. So they will only owe a dividend. They have an obligation only when they declare it. So dividend owing is only when they make the pronouncement that we are declaring dividend of 50,000. It starts from that day. So even if they tell that last year dividend, we are going to declare it next year, they don't owe until they declare it. So dividend is not something that is obligatory. It is by policy. And policy, no one can attack. There's no law, not even a company's code. So take notice of that. So wherever it's time to pay dividend, record that particular date. That's all. The next example I'll give is going concern. The first two examples are very, very technical. So please take note of this, the first two examples. I call it going concern threat. Going concern threat. And I think there was a question Target Professional Council produced on the going concern threat when the COVID came. This is how it works. Typical example, the year starts from January. Please, all the examples I'm giving, our year starts from January. It ends at December, so that things will make very simple. In reality, in some of the exam questions, it will not be like that. So know that when the year starts from this month, 12 months time to end, no problem. Then this is 2019. 2019 December. So somewhere, you know that around 1st March, we lost $10 billion due to the COVID-19, because at that time, we have no work. And all employees got COVID. All employees got COVID. Our workers, everybody, and we have lost money, 10 billion. And this 10 billion could collapse the business. This 10 billion could suggest that this loss of 10 billion could suggest that the business does not have a going concern. So the loss of 10 billion after the reporting period could suggest that the business may not have going concern. It may collapse. And don't forget, some of the accountants will say that, okay, can I make a provision toward this loss? No, please. We are begging you. Legs on the floor, please. The issue is that, yes, indeed, you have made a material loss after the year end, which will affect your survival. But there's no evidence that suggests that you are going to make that loss before the year end, and hence you cannot adjust your financial. Instead, come back and amend the basis of preparing the financials, because now you prepare the financials on the assumption that you live to see tomorrow, you have a going concern. Your business will not collapse now. But shortly after preparing the financial statement, you had a material loss that could threaten what? Your going concern. So in that case, why can't you come and change the basis of preparing the financials? So anytime there's a material loss after the year end, we only change the basis of preparing financials. We don't amend the financial. We don't adjust the financial. I hope it's very clear. I hope it's very clear. And that is it. So basically, that is what we are trying to say. That after the year end, any loss is suffered. So there was a question Target Professional Council produced in 2020 when the COVID came, that COVID-19 has posed challenges to a lot of companies, and then they made a loss of 10 billion. Now, as an accountant, how should they account for this 10 billion loss? So the examiner, 10 billion loss is an example of event after reporting period. However, due to the fact that at the end of the reporting period, there was no evidence that COVID-19 is going to bring a loss of 10 billion, and hence the 10 billion should affect the following year. However, if the entity consider the effect of the 10 billion as a threat to their going concern, then the entire financial statement must be prepared under breakup basis, reconsidering what? The base of current financial statements. We are done. That's the answer. Now let me go to example 3. I'm giving you 12, then I'm done. Example. The rest in there is self-explanatory if I mention it. Then we go. Don't forget 12. I have to give you. Major business combination. So major business combination, IFRS 3. Yes, Tigo. 2 companies merging, acquiring each other, all of them. Announcing a plan to discontinue an operation, all this. And this one, level 3, please. IFRS 8, operating segment. That's where they can mingle it. Announcing a plan to discontinue an operation. So if any of the airlines tell us that next year they announce that, okay, so this year we are not going to do one of our service again, one of our operations again, so it's non-adjusting event, you go. And then destruction of major production plant by fire after the reporting period. Destruction. 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 Take notice of destruction of major production plant. Production of by fire. Please, who caused the fire? The fire here refers to natural disaster. So there was a question IC examiner said, they made it earthquake. Earthquake occurred and some of their production plant got spoiled. It is typically non-adjusting events. We are done. Now let's move on. As I'm giving you 12. So when I get there, I'll stop. All these are non-adjusting events. Take notice. So if you see them anywhere, tell the examiner, I've catch you or I've noticed it. Now let's go. Number 6. Announcement or commencement of major restructuring. Announcement or commencement or commencing, announcing or commencing restructuring. Major restructuring. Major restructuring. And then which one again? Number 7. Yes, I'll give you plenty, don't worry. Major ordinary share transaction. Major ordinary share transaction. That's issue of shares after the year end. So if the company waits right after the year end, they issue shares, please don't come and adjust the financials. We are begging you. Please God beg you. Changes in asset values. Changes in assets values or foreign exchange rates or changing foreign exchange rate. Don't come and tell us that because foreign exchange rate has moved, you're going to adjust after the year. No, foreign exchange. So those who are doing FR, advanced financial reporting or corporate reporting or strategic business reporting, if you are doing foreign consolidation and the exchange rate change, move after the reporting period, please don't adjust anything. Number 9, changes in tax rate. What a wow. Changes in tax rate. All this will take place after the year end. I said I'll give you how many? 12. Number 10. You see that there are many pounds. Entering into commitment or contingent liabilities. After the year end, you enter into what? Commitment. So entering into commitments. Into commitments. You commit yourself that I will pay you this amount after the year end. So entering into what? Commitment and contingent liabilities. Let me go to number 11. I have to fulfill my promise. Commencement of major litigation. Commencing major litigation after the year end. The one, add yours to it. Add your own ones to it. Not part two, please. Okay, so let me just end here. All right, so on that note, IAS 10 has been dealt with. I have some practical examples for you. So I'm going to project some questions and you have to look at it for me. You screenshot them, solve them for me, and we move on. So when the question comes, I have some example before you. All right, so this example for the day. So that the management of an entity completes their draft financial statement for the year ended 31st December 2001 on 28th of February next year. Okay, so they completed the 28th of February 2002. On 18th March 2002, the board of directors reviewed the financial statement and authorized them for issue. When did they issue it? 18th March. They issue it, no problem. The entity announces its profit and selected other financial information on 19th March 20x2. The financial statements are made available to shareholders on 1st April 2000x2. The shareholders approve the financials at their annual meeting on 15 May 2000x2. And approved financial statements are filed with the regulatory body 17th of May 2002. So the financial statement, we can say that they are authorized for issue on 18th. That's the date of the board for authorization. So that's the typical example of when we can say that the financial statement have to be published. So take notice of that. All right, so any question, you can put your questions, suggestions, comments, and I'll pick them up and do justice to it. All right.